Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, as another quarter comes to an end, or nears an end, I should say, we try to take a little bit of a look back and a little bit of a look ahead. And we're going to do that this time around with stock strategists Brian Bolin, Tracy Reinick, and our research director, Shiraz Mian. Let's take a little bit of a look back to last week, first of all, and Bernanke's comments about tapering the QE program. In light of those comments, what do you think about this bull market run? Does it have more room to go, or is the taper talk going to kill it? Shiraz, you said the bull market's over.
Yes, I think it is. And the reason I'm saying that is that if the way the market is interpreting the Bernanke announcement as a steady process towards normalization, so tapering in a couple of months, ending the QE program altogether by the middle of next year, and then at some stage looking ahead, maybe early 2015, to a rate hike, this puts us in a completely new framework relative to what the market's been used to over the last 4 or 5 years. What we have been used to over the last 4 or 5 years is that the Fed was this omnipresent entity at the back of the market, which gave investors in the market the luxury of essentially ignoring everything about earnings, about the economy, about all the fundamentals. So now if you have the Fed step back a bit from that role and move toward a more neutral stance, then you get to start focusing on earnings and other corporate fundamentals. And I don't think those are as good.
All right, so you're looking basically through the summer months for the market to continue to drift lower, stabilizing at some lower level after the summer.
Significantly lower level after the summer than what the consensus view is. The consensus view appears to be something in the 1550-ish kind of range for the S&P 500, which would get you like about a 10% correction from the May top. I think that's way too optimistic a take. I think if the scenario that I'm drawing, you get to in the lower 1400s, maybe even lower by the time the dust settles.
All right, Tracy, you still don't know what to make of Bernanke's comments, but the one thing you do know is that the Fed definitely still a major market influencer. So does that mean that it's going to be the biggest source of market volatility here for the summer?
Well, we'll see what they do at the next meeting, but I actually kind of agree with what Shiraz said, except for one little divergent. If they're going to come out of the stock market, we already know we're seeing this violent sell-off in the bond market. We're seeing sell-offs in all the emerging markets, stocks, bonds, everything. Commodities are basically in the tank. Where do you go? We just had this last week the biggest sell-off in bonds in 20 years, apparently, is what all the guys who tabulate all the data are saying. So that's like billions of dollars, up to $10 billion came out last week. So where's that going to go? So while I kind of agree with Shiraz's assessment, at least initially, I think it's all going to go into equities. It's the only area that, you know, a lot of this money is going to be able to drive into, and I think that once we get this pullback in equities is going to push it forward again. I don't know if that's late in the summer or what, but I think the money's going to go into stocks.
Interesting. Brian, what about Bernanke's comments? A surprise to you?
I think it was somewhat surprising, and I think the big idea that everyone kind of glosses over here is the idea of, you've heard this saying before, Terry, the ifs and buts, cherries and nuts. You had a big if in his statement when he was talking to the press, and that's when the market really kind of fell off. And he said, if unemployment goes down, and pulls back in, then we will do this taper. But everyone just heard, we will do this taper, or whatever they heard.
Tapering the paper.
Right, taper the paper. So it's that big if is the problem. And I think last month we saw that the number of jobs increased. We saw the unemployment rate also increase. Kind of a little problem in there. It throws a monkey wrench into the system. If you have all these people coming back into the labor force, unemployment continues to move up, that means there's not going to be the taper that everyone is looking for. And when it doesn't happen again and again and again, that's when the market's really going to have a real jolt higher.
So in your opinion, investor concern over the tapering is not totally unfounded. It's not overdone.
Right.
Shiraz, you say it's not overdone as well. it's completely justified, right?
Oh yeah, I'm for different reasons, for completely the opposite reasons of what Brian is saying. Now, in fairness to his stance, if the taper is not going to happen, if the Fed is not going to normalize its monetary policy stance, if it remains this omnipresent entity that I alluded to earlier, then yes, then there's no reason to worry about for the market. My entire thesis is premised on this outlook that the Fed believes the economy is good enough. It's not very robust. It's not growing very strongly, but it's stable enough that they don't need to provide the level of monetary stimulus going forward.
Well, he thinks QE is going to take a decade to unravel.
That is true. It will. But you stop the fresh bond purchases that they have been doing over the last many months, and then you start look ahead to this period where they will stop reinvesting the maturities of those bonds. So yes, I think this is fair that the Fed balance sheet will remain in the trillions size level for many years to come.
So going forward, Tracy, where does the stock market take its cue from? From the bond market? From China? Because there's a credit crisis maybe looming over there, right?
I don't know. We got all these signals kind of going on at the same time, like I said.
Got Fed speakers this week.
Right.
Everybody's going to be looking to parse their words for any clues, many more clues.
Well, they are, and a lot of people think that, some of those statements might be made to appease what's going on right now, at least in the sell-off in stocks and in bonds. But I don't know. I mean, we're in this kind of quiet period before the earnings season, so we have at least another week, 2 weeks. We got Alcoa coming up the second week of July, and then we're going to focus on what the companies are actually saying. So I think it's going to be real volatile until we start to hear from the companies themselves.
And what about you two guys? Don't gloss over anything now, because Brian will definitely
bond market is the primary driver right now. We have a 2.6. Does it go to 3%, 3.5%? What does that do to housing? And mortgages, and all of those questions about the recovery sustaining. So the bond market would be the primary catalyst near term, but China is a question that's lurking in the background, and everybody's concerned about it.
Why is China important to us, Brian?
Well, the credit crisis over there, if that really comes into something that is worse than expected or blows up, then we're really going to have a problem, because it is such a big trading partner. I think if you look at over the last several decades, the importance of China and how it has increased in size as a trading partner with the U.S., that really bears weight on the broader economy if they have a credit crisis. So if they are having issues with their money and what's going on there, it's going to be felt over here.
All right, well, I know you guys will be keeping your eyes peeled for anything new developing as far as trends or any furthering of the trends that we talked about here. And another thing that they've got their sights set on are their top picks for this week. Those they share in our next segment.